just pull out a couple of stocks. Intraday charts would come up for you. India Mart, it's really been one of the go-to stocks for the shorts. Just look at that. That one's moving lower. A couple of IT stocks have been low through the day. TCS, for example, and Birla Soft is another one. And just in the last 10 minutes of trade, Balrampur Chini has seen a very sharp drop. See the intraday chart of Balrampur Chini. That as well is moving to the low point of the day. The Nifty is still holding firm with about 50-point gain, and the Bank Nifty up about 300 points. Rupen Rajguru is joining us. He is Head of Equity Investments and Strategy at Julius Baer. Rupen, hi, good afternoon. Thanks a lot for joining us. How are you approaching this phase of the market, showing resilience in face of a lot of bad news?
Yeah, hi, afternoon, Anuj. What we have been maintaining that in the near term, probably while there might be day-to-day movements, but we are guided by the way the global markets will move. And probably the market has been quite fast and furious in doing all kinds of adjustments, right? So, and from a global market standpoint, now the inflation shock is kind of behind us, and we are trying to see how much market is pricing the slowdown stroke recession shock, right? And so from an Indian market, extremely near-term perspective will be more guided by the way the global markets and the global flows will move. But having said that, over medium to longer-term perspective, we have shown that our overall growth, both in the economic, that is the GDP growth, as well as in the earnings growth, will be far superior than any other large economy in the world for next couple of years. So to answer your question, we are constructive on the Indian markets, but difficult to pinpoint that if tomorrow the global goes down 10%, we might follow. If not down 10%, we might go down 5 to 7%.
Hi, Rupen. Thanks so much for joining in. Rupen, I wanted to ask you about your big contra call, the auto space. That's worked out pretty well. The question is, what do you do from here? If I look at the Nifty year to date, it's under some pressure. The auto index, though, which was otherwise underperforming, that's been a relative outperformer. It's up close to around 7%. So you've played that rally. From here on, what do you do? Will you continue to remain positive on these stocks, or do you believe the best is behind?
Hi, Nigel. Afternoon. Auto as a sector, I would call it as part of the a relative value play, which has worked out pretty well in the Indian markets, for that matter, even in the global markets. As I've indicated to you earlier, that auto came through a very tough cycle. So the auto profits probably peaked in, say, 2018. And if I were to only look into the Nifty components of the auto components, the profits actually halved between 2018 till 2022. So we are now probably seeing the readjustment, a cyclical recovery for that sector. So that recovery will last for some more time, right? It's a 1 quarter or 2 quarter recovery. It might last for a year or so. Secondly, while the auto sector stocks have gone up, but the valuation wise, they have not reached the level at which probably they were pricing in a peak of cycle or so. So we believe there are still, while the big story has played out, so from the extreme overweight position, we have reduced our weightage out there, but we still remain positive and on the sector, and we believe that the rally in the sector might continue for another quarter or two.
Okay, that's on the automobile space. Now I'm reading from the note, and I believe you are negative on midcap IT even after the correction, while also maintaining that there's some value now in large cap IT stocks. If you can explain the dichotomy here.
Sure. So Anuj, like auto, reverse played out in IT. So IT sector probably touched its bottom in say 19 rather, and thereafter. So till 19, the general consensus amongst large cap IT was, we were all expecting say 5 to 7% revenue growth, and that thereafter added the COVID tailwind that trajectory moved to 15 to 16%. So like last 2 years, the growth for large cap IT has been 15-16%. The mid cap IT has been even higher. But in the interim, what has happened because of this massive change in the revenue trajectory, the sector got massively re-rated. So the re-rating in large cap, which were earlier trading at say 16-17 P multiple, went all the way to say 20, almost 30 P multiple. The mid caps, on the other hand, which were trading at around 10-12 P multiple, got re-rated to 40-50-60 P multiple. So now there is a possibility of a headwind. So probably that growth of 15-16% might come down to say 13-14%, not a significant degrowth, but still a degrowth. At the same time, the cost pressures are there. So while the large cap ITs might be able to deal with the cost pressure much more in a better way than mid cap IT, and the mid cap IT are more vulnerable to derating. So while they have derated, still at a overall level, they are trading at a valuation which are higher than large cap IT. So to conclude, we still maintain that the mid cap IT can be vulnerable to downside if the results, which we will see in this ensuing quarter, if they are not up to the mark, we might see another leg of derating.
Okay, all right. Rupen, what about, you just mentioned about IT. On mid-cap IT, you're sounding fairly cautious. But the rupee has depreciated. And you're looking at the pharma stocks, to play that theme. Give us some more color on that. If you could tell us stocks that you'll hold in your portfolio as well as a disclosure. Go ahead.
Sure. Pharma, again, it's a very large sector. It's not a homogeneous sector. So this sector also has witnessed a lot of stress after seeing the highs a few years back. While we are seeing recovery in that sector, the one big data point to watch out there would be stability in the US generic pricing. So while they are still going down, but at least the recent commentary what we saw from the management, they are indicating that finally they are seeing some bit of stability from the price going down further from there, the US generic annual. At the same time, the domestic branded business are doing pretty well. So from our perspective, we like some of those large pharma companies which are strong domestic branded franchise and are also in the international market, not only focusing on generics, but also on the specialty side. So there where we are seeing traction. Apart from that, within the healthcare, we also now post correction, we like some of the diagnostic plays because those sector stocks got significantly re-rated last year because they had an additional COVID related revenue bump up. But now it's no longer there in the base. And now we are seeing the true growth for them. And post de-rating, some of the diagnostic plays are also looking pretty attractive.
Okay. What about some of these domestic plays like cement, real estate? Any calls here?
So as a big theme from our perspective is that the domestic capex cycle is definitely recovering, and we are already seeing that happening because if you read through the commentary of the order book for a lot of the industrials, capital good players, we are already seeing that happening. And the real estate cycle actually, now we are in the second year of an upcycle in real estate, and real estate cycle typically are last anywhere between 6 to 8 years. So we are probably not even in the middle of the cycle as far as real estate is concerned. And in fact, just to give perspective, last year our the overall residential sales were up 28%. And if you see the commentary for this year, especially from players of Bombay or Bangalore, it's been pretty strong. So cement also has a close linkage with real estate because roughly half of the demand comes from real estate. So we are constructive on the capex cycle. So real estate, we would like to play more through real estate ancillary than direct real estate plays. And cement, which has a indirect play on real estate. And secondly, the cement stock has seen a very sharp correction because the input costs just shot up significantly, and now we are seeing the input costs are coming off. So we will see the benefits of that coming through in the subsequent quarter. And finally, typically 18 months prior to the general election, we see a lot of spending happening from the government side, which also is typically from the infrastructure and others which are job creating, which also is good from a cement sector perspective. So constructive on the cement stocks, and probably there, the large companies, the largest companies, something which we like in the cement space.
Rupen, just hold on to that thought. As we speak, the 20 DMA is here. The Nifty has moved to the high point of the day. It's looking quite good, at least. Let's see whether we have a flourish in the final few minutes. But good move is what we've seen on the Nifty, trading just above that 20 DMA odd. Rupen, very quickly before we let you go, you mentioned Diagnostic as well as cement stocks. Now, both those two spaces have got absolutely thrashed. Give us some more color from the Diagnostic space. Is it the north-focused company that you like, or is it the one that's tilting towards the west? And also on cement stocks, if you could tell us, you like the large cap, you like the north-based, the big name out there, or you prefer the largest cement company in India, which has pan-India presence? Very quickly.
Yeah. So, see, Diagnostic, Nigel, as a sector, it's also at a top-down level a big play on shift from the unorganized to organized, right? Because it's a pretty large industry, and the mom and pop shops would be around 80% market share out there. While there are new players who are coming and the competitive intensity is going up, but the large players which has a strong presence. So to answer your question, from our perspective, we like more which is present in the western and now in the southern belt, and the stock has seen massive derating. The earnings have come off, and there has been massive derating. So from here on, we believe this is a good base from a next 3 to 5 year perspective for all the diagnostic player, and particularly the player which I mentioned. And because the big chunk of their revenue comes from the specialized diagnostic services there, which is a high margin business, and there we don't see any issue despite competition coming through. So that's as far as the diagnostic players are concerned. And from a cement, when we see a big tailwind coming through, the largest player is something which we like, which is present across pan-India. And there are a couple of bottom-up ideas there. Some of the companies which has extremely good cost metrics. So while the direct input cost went, but the others have done pretty well. So that is something which you like.
Okay, Rupen, thanks a lot for joining us and giving us your views. The market, by the way, is now surging. It's at the high point of the day, and it's